Initial first phase of the Fed announcement. So we've had the statement, the summary of economic projections, and we've also still got ongoing here in the background the press conference Q&A with Janet Yellen. So just recapping exactly what's gone on here is looking at the charts. As you can see, obviously a hawkish reaction has been seen in the marketplace, a sharp appreciation of the US dollar as defined by both major pairs here. You can see euro dollar and cable top left, both coming under pressure. Gold has spiked lower, approximately $17 since the event took place. US yield spiking higher, so consequently the US 10 years down about 12 ticks, only a couple of ticks from its initial low that was seen in the wake of the announcement. So what is it exactly that's been said and caused this hawkish reaction in the market? Well, first things first, got to look at the actual meeting statement. So obviously we weren't expecting any move on interest rates. This isn't what today's announcement was about. What today's announcement about was the assessment of the economy, the projections, and then also some details around this balance sheet tightening process. Well, a couple things here in the statement just want to highlight that will reflect hopefully some of the reasons behind why the market moved like it did. Now, this first comment, I would say the jobs, the employment situation of the US economy is not so much of a consideration for the Fed. It is, though, as termed by Janet in the press conference, one of their key parts of their mandate. They did say job gains have remained solid in recent months and the employment rate has remained or has stayed low. If you remember, this comes obviously after a disappointing non-farm payrolls we had at the very beginning of the month. At that time, I remember the federal funds rate futures had a deck hike priced at about 30%. And we'll see later what we're priced at now, but it's much higher than it was just a few weeks ago. The other parts here that were quite interesting and jumped out pretty quickly was this particular reference to the weather systems that have impacted the US economy. Hurricanes Harvey, Irma, Maria have been some of the most strongest hurricanes that the US has seen in many years. Harvey and Irma in particular have devastated many communities, inflicting severe hardship. Storm-related disruptions and rebuilding will affect economic activity in the near term, but past experience suggests that the storms are unlikely to materially alter the course of the national economy over the medium term. And I think that was quite an important comment on the hawkish side. There could have been some downgrading of growth potential on the back of economic output being reduced by the severe weather patterns. However, the Fed is saying yes, that will happen in the near term, but in the longer run, actually, it won't have an impact because of the relief aid that got signed off by the US and the recovery and construction infrastructure that will take place thereafter. The other parts here that were quite interesting: economic activity will expand at a moderate pace, labour market conditions will strengthen somewhat further. If you remember, the Fed's kind of play on the inflation side is the fact that a continuation of tightening of the labour force will consequently lead to then stoking demand and therefore higher inflation going forward. They continue to see that being the case, that the labour market will continue to strengthen. Now moving on, near-term risks to the economic outlook appear roughly balanced. The committee is monitoring inflation closely, so inflation remains to be a very key measure that the Fed are looking at. Then here, the stance of monetary policy remains accommodative, thereby supporting further strengthening of labour market conditions and a sustained return to 2%. So again, really, they're just reiterating what they have said before on the inflationary issue. Now, moving further down, the committee expects that economic conditions will evolve in a manner that will warrant gradual increases in the federal funds rate. And so, again, this kind of validation of their strategy that's been in place since the December 2016 projections, when they said they were going to do 3 rate hikes in 2017. Well, from what's happened here, we're still on for that. They've hiked rates twice already, and now we're looking for December for that final interest rate hike. However, they did say the actual path of federal funds rate will depend on economic outlook as informed by incoming data. So this is that data dependency. But again, this is just a repetition of their usual stance in that way. The balance sheet actually was a bit of a non-event, i.e. it's happened. The process has begun, the unwinding of QE. They said in October, so that's in fitting with the market expectation. The committee will initiate the balance sheet normalization program described in June 2017. So those numbers that we had before about the 6 billion in treasuries to 4 billion in mortgage-backed securities, that's just been confirmed. So as expected, the Fed have done a pretty good job actually of just feeding this into the market over the period of several months. That wasn't so much what moved the market. We move over though to the summary of economic projections and things get a little bit more interesting, because if we look here on the left hand side, what we're looking at here is the latest September projections, and then below each area of measurement the June projections, so you can see the actual change. Now I think this was a hawkish surprise. You know, if you thought 2017 was going to be impeded by maybe, as we say, some of the short-term ramification of the adverse weather conditions, that hasn't materialized. In fact, the Fed have gone the opposite direction. They've changed in real GDP. They see at the end of the year 2.4%. That's a 0.2% increase. Sounds small, but that's fairly significant. And then they've only see a marginal decrease then, or marginal increase again in 2019. So if anything, they've got more bullish on the prospects of growth for the US economy in the near term and the medium term. Then in inflation, if you look at things like core PCE inflation, yes, it has been downgraded from 1.7 to 1.5 near term, but what struck me was the fact that 2018 and then 2019, it completely bounces back to level out. This then validating their strategy of the tightening, or what they foresee of the labour force, means that this inflationary drop, in their own words, is seen as more transitory. And so actually then there's no need to be as concerned as maybe market participants had become. Looking at the dot plots, no change at all for 2017, 2018. Some had feared maybe you might see a slight tweak to the 2018, which didn't occur. 2019, albeit, was slightly lower, so the trajectory has become slightly more shallow on the long end, if you like, but changes were overall fairly minimal. So you've got more bullish on growth, not as severe downgrades to inflation as expected, and minimal changes to the federal funds rate. And then the final piece of the puzzle, the actual Fed members, 11 of them are seeing now the need for hiking going forward, comparative to 8 in June. This is in regards then to the countdown for December. Let me just refresh this. This is the federal funds rate futures, the short end of the fixed income curve, which is very interest rate sensitive. We're now pricing in 66% chance of a December rate increase of 25 basis points. As I said, after payrolls at the 1st of September, this number was down at 30%. So it's more than doubled, and now this is fully priced in, or not fully, it's well priced in. Given what's occurred and what the Fed has said tonight, I would be expecting going forward through the coming months, unless something unscheduled occurs from an external point of view, i.e. North Korea, Trump does something, another severe hurricane that hits a centralized area of America, then you would expect then this number to continue to remain fairly high as we get closer to December. I'm sure the Fed's objective will be to push this up towards 100%, so that when they execute that final rate hike, it has minimal movement on the market and they achieve price stability and lower volatility. So overall then, looking at the markets, the reactions were very interesting. Obviously, dollar strength really fed through. Euro, clean pop to the downside. A little hesitation as we got down to the weekly low. That could have been the good point of entry then, if you're missing the fast money move to get short the market. And it's then pushed down to find a bit of support around the cluster of price action that was seen around midweek last week. Cable, likewise, pretty significant level at 135 that's defined the weekly low, and S1 on the session on the pivots was kind of the target for the initial spike lower and the breakthrough pivot, and that level's held up thus far. One of the interesting trades though was gold. because gold has been incredibly sensitive to US economic data and announcements on monetary policy. Same thing happened again. This is looking at the initial move. You can see in its entirety we've gone from R1 at 13.17 all the way busted through S2 down to the $1,300 test. So a $17 move. Looking on this a bit more longer time frame, you can see how these technical levels were playing out quite nicely. The initial break of the weekly low that was seen on Monday around 13.08. Then we went through S2. Then when we initially broke, then the end of August low at 13.02 in the futures, that matched with the $1,300 handle in the spot market, and then we saw another push down to test in the futures just sub the $1,300 level. That psychological support though just coming into play, and a slight bit of recovery, albeit gold still lower in the wake of the Fed's hawkishness. Equity markets a little bit more tricky. This is always the case with this specific asset, because the initial reaction is, wow, the Fed's hawkish, more tightening of policy going forward, more bullish on economic growth and so on and so forth. Equities initially come under pressure. So you can see this S&P dip. We break the Monday low, which kind of matched up with the S2 level and the 2500 level already gone in that move. But then actually once she started talking, equity markets have started to recover. What makes equities a particularly tricky asset to tackle in this environment is the fact that if she's positive on the US economy overall, well then this should validate US corporate valuations and their profitability going forward. And so rather than the more one-dimensional move of being hawkish, translating to dollar strength and higher US yields, it makes it a little bit more tricky, and you get this twofold reaction in the equity market. So a good lesson here. Maybe that's not the asset to really focus on so much, where gold, T-notes, and the currency pairs on the back of the dollar movement quite often offers you the better opportunity. Okay, so that's pretty much it. That's your wrap. I can see Janet still going at the moment. I'm sure she'll still be answering a few questions, but the event by all means is probably done by now. A quick look at the calendar for tomorrow just to quickly wrap things up. You have the Bank of Japan interest rate decision coming out overnight for any FX traders. Not expecting any change in rates there though, but commentary as ever will be key. You then go into public finance data and mortgage approvals from the UK tomorrow at 9:30. It's Thursday, so regular jobless claims from the US alongside Philly Fed. And then you also get the European consumer confidence number at 3 p.m. So nothing here that screams out potential market movers, albeit for currency traders for Japan and the yen, you've got that rate announcement overnight. Draghi is on the schedule though, 2:15 tomorrow. Gives welcoming remarks at an annual conference. Always worth paying attention when the president is speaking. And then of course, not on here, there is no set time that I'm aware of, but there is a Conservative cabinet meeting happening Thursday evening, I believe, in Florence, ahead of then Theresa May's key Brexit speech, which she'll deliver on Friday. Okay, gonna leave it at that. Hope you traded that well. I know some of you did in the live room, so well done. Have a good evening, and I'll see you bright and early tomorrow morning. Okay, take care guys. Thank you.